Good morning, everyone. Thank you for joining us. This is Lisa Kirschenbauer with President and Founder of Omega Wealth Management. Today, this month's webinar is the Washington Region's current economic performance and near-term outlook. This is going to be our first webinar where we are sharing presentations and sharing speakers at different locations, so please bear with us. Before I get started, I'm going to just provide a few updates, and then we're going to hand it off to our guest speaker today, Jeannette Chapman. We've got you all on mute for the moment, but if you do want to ask questions of Ms. Chapman, if you go down to on the right-hand side, you should have a box where you have some controls, and you'll see questions. If you drop that down, you can put in a question. We'll be monitoring those. Ms. Chapman may take some of those as Jared Jones, our Associate Financial Advisor here and Director of Investments at Omega, is going to be monitoring the questions, and we may intersperse that into the presentation, or Ms. Chapman may decide to take some of them a little bit later in her presentation if she knows that your question may be answered as we go forward. So again, thank you for being here. We expect other people will be joining. We are going to be recording this as well, so you can listen later on if you want to. And there's a lot of great information that Ms. Chapman's going to be sharing with us. So let's go ahead and get started if we could. Want to share a few updates as far as what we're doing with Omega and living through the whole coronavirus experience. And I think that's the only way to really put it. We are all working from home very effectively. We have been home since about March 16th. And luckily, we had already been using video conferencing with our clients prior to this. So we have some experience with working remotely and virtually, but we've taken that to a new level. We are conducting all of our new normal regularly scheduled meetings with clients because we think it's important to connect with our existing clients. And we continue to work with new clients. It can be done virtually, and we welcome new clients joining Omega during this really important time of uncertainty and unknowns. And we plan to continue working remotely at least into and through June, and then go from there as far as perhaps starting to gradually return to the office. So more on that later. We have also added some new electronic capabilities with DocuSign, and so that we can do electronic documents, and then we've expanded our video conferencing tools to try to find the best tools to be able to communicate with everyone. We've got a mix of people on here today, not only Omega clients, but we also have a variety of partners, professional partners and advisors that we work with our clients. So we welcome all of you. And so this presentation really is for everyone, whether you're a personal or private investor, or whether you work with a lot of clients who may be investors. We are also hoping to bring on a new and experienced associate sometime in the next few months. We're beginning that search process right now as we continue to grow our business regardless of what's happening in the short term. And so more on that as we find the right person. One of the things that we like to talk about here is making lemonade out of lemons. This is a lemon period of time, and I've been through this before. When we go back to the financial crisis, and even before that, the dot-com bubble, one of the things that I believe is how can we take advantage of some of the negative news and some of the negative experience and turn it into lemonade. And so there's a few things that we're trying to do from both an investment and a tax planning experience. Number one is we're looking to do some investment loss harvesting. Honestly, we haven't had a chance to harvest losses from clients' portfolios for years, and I'm hoping we don't have a chance to do it for a long time after this. So we're going to be looking at can we take some losses now that we can offset with gains later? And then also, this is an opportunity to be thinking about if we want to move to a different kind of investment strategy at a lower price, why wouldn't we want to buy in now? And finally, looking to do some Roth IRA conversions and to take advantage of making that conversion at a lower value and then having the money recover into a Roth IRA account, which will grow on a completely tax-free basis. So we see that the lemonade and the lemons, and we've been reaching out to individual clients to pursue those possibilities. Well, I also need to say that we expect that there may be another downward turn with the stock market before we see any sustained rally. Just yesterday, I was looking at an article from the Washington Post that thinks that we may have a W kind of recovery. And if you can imagine that we've just gone down the first side of the W, we've and started to have some rally. And because of the health considerations as well as the economic considerations, we would not be surprised to see another downturn before we see a sustained rally. And part of that is because we feel the stock market may be responding to health news, but not fully digesting all of the economic news that continues to unfold. So we'll see what happens, but we would prefer to be prepared for negative news and be proactive than to be caught flat-footed. And then finally, the thing that we always want to say, because sometimes our clients have asked us, gee, should I keep putting money into my 401k or continue my automatic investment program that I've got set up? And the answer is a resounding yes. Please keep putting money in. If you've got an automatic and systematic plan for investing, keep doing it. If it's a long-term strategy, we think that makes a lot of sense, but of course we're always happy to talk with our clients individually to strategize and really personalize what your experience is and what your action steps should be. So that's our update for now. I'm going to be turning it over to Jeannette Chapman, who is the new director at the Stephen S. Fuller Institute. And this is an organization that I've been familiar with for a while, but I'm going to let Jared take over, introduce Jeannette, and let her run the rest of the program. Thanks again for being here.
Thanks, Lisa. It looks like we have a couple of people letting us know that there were some issues with the sound there. Hopefully we're going to be changing presenters now, so hopefully that's fixed. But if you guys have any other issues with the sound, please let us know, and we'll try and work on our side to resolve that. You can just let us know in the question box. So thank you. Today we have a special guest, as Lisa said, Jeannette Chapman. Jeannette is the director of the Stephen Fuller Institute at George Mason, where she examines the Washington's region economy and demographics and the housing market as well. So with that, I'd like to turn it over to Jeannette, and bear with me. I'm gonna give her the controls to go through the PowerPoint slide, and I believe you can take it from here, Jeannette.
Great, I've got them. Awesome, just double checking. So Good morning, everyone. Thank you for having me. I am going to run through a lot of material. I have about 40 minutes worth of material, so that we should still have plenty of time for questions. I'm going to talk firstly about the pre-pandemic performance of primarily the Washington area, but a little bit of the nation as well. Then I'm going to move into what we know about the pandemic, what sort of data points we are tracking and how we can measure the depth of the recession thus far. Then I'm going to follow it up with a little bit of information about where we are with our jobs numbers as of March, and then close it out with some forecasts. And so just so that you have that in your mind for if there are questions that come up, that I will pause at the end of each of these break points so that you can go ahead and throw some questions at me if that makes sense, or we can take questions at the end. I haven't done questions in real time on a webinar before, so we'll just sort of see how that works. As a reminder, prior to the pandemic, the nation was in the longest business expansion on record, with data going back to 1854. The red line on this graph charts that progress, and you can see pretty easily that not only was it longer than all of the other expansions that you can see on this graph here, it was also much slower, which partly explained why it lasted so much longer. We never really heated up like we did in other expansionary periods, and for most of this expansion, we've kind of been running around average growth rates as opposed to above average like we usually see during expansions. Now, as of, I guess, over the summer is when, or even earlier than that, a few months prior to that, is when people were starting to say, okay, well, we're in the longest business expansion right now, and things don't continue forever, and we're starting to discuss what the next likely scenario of a recession was. At that time, the most likely case was going to be for almost a self-fulfilling recession, where consumers and to some degree businesses just got nervous and stopped spending money because they were starting to plan for the next recession, and they would pull back enough that it would cause a mini dip. And in that scenario, it would have been a short, fast recession that recovered pretty quickly. And I'm doing this reminder partially because some of what we're seeing right now is actually echoes what that scenario is, although there's a reason for the pullback in consumer spending, and there are also going to be differences in how it plays out. But it feels like an eternity ago, but this is where we were thinking probably not even 3 months ago at this point. The Washington area, however, has not had an expansion that has lasted that long, because we had a recession in 2013 and into 2014. These are annual data, so you don't see the quarterly and monthly changes. In 2013, what happened was the federal government pulled back on spending, both direct and indirect, in terms of procurement. And so our region had a recession that almost went unnoticed at the time, unless you were really digging into what was going on, or maybe actually this group may have realized it faster because you're dealing with portfolios, and so that showed up on the income side as well. Since then, the Washington region has underperformed the nation on average, and we've been underperforming our peer metros. We've been slowly getting a little bit better, but we still haven't quite rebounded back to where we were prior to the sequestration period. As a reminder, in 2009, even though we had job losses, we actually didn't have an economic contraction, because the types of jobs that we were losing in 2009 were lower value add jobs, and that was being offset by increases in higher value add jobs. And so this is where some of what we're talking about sort of in historic terms becomes relevant for what we're looking at right now, because there isn't necessarily going to be one number you can look at to determine a holistic view of the economy. And again, you know this, but it's worth repeating. So just to recap, prior to the recession, or prior to, I guess, the pandemic, the Washington region was more or less underperforming the national average. And the major reason for this was because of job growth. Sorry, forgotten where I was in the slides. So job growth here, you can see the first red bar in 2009, or the bar sort of in the middle, is the number of jobs that we lost during the recession. Again, these were low wage jobs. Job growth bounced back very quickly after the recession. We were ranked first in the nation sort of in the 2011-2010 period. And this metric, we were first across the board for job growth, population growth, or we were very high in terms of most statistics during this period, because we recovered much faster, because we had very little to recover from, to be honest.
Jeannette,
after that, you see this, yes.
I'm sorry to cut in. It looks like we're having some continued issues with the audio. I just want to let the audience know, if you're having any trouble hearing Jeannette talk, try and refresh, close out, make sure everything on your computer is closed out, all the applications. That might help. And if you have continued issues, please call in by phone. If that doesn't work, I just want to let everybody know that we are recording this and we will be posting it later. So we apologize and thanks for your patience. So back to you, Jeannette.
Okay, great. Sorry about that. So after 2010, 2011, you can see that there's been this pullback in job growth. That was because of the sequestration, the drawdown in the stimulus, the drawdown of the conflicts of in Iraq and Afghanistan. They essentially all hit at the same time. and it directly affected our job growth and our economic growth. Now, in the past 5 years, our region has performed well, it's performed much better, but it still lagged the national performance, although our performance has mirrored the national performance in that our expansion, I lost the,
Oh.
I may have lost the controls. Did I lose the controls?
I think you have it.
I have it.
Yeah.
There we go. Sorry about that. So our job growth has been below what we would expect during an expansionary period. So our job growth for the past 5 years has been average for this roughly 30-year period, almost 30-year period. And average isn't really what we would have expected in this late in the business cycle, which is why I think there was a little bit of a consensus around when I was just asking people around what the climate was like. They were okay, but they weren't happy with it being okay because it should have been better. In 2019, our job growth composition was actually better than it had been in earlier years, even during this sort of 5-year period. Job growth was driven primarily by business and professional services. These are our high value add white collar jobs, and the mix even within this sector was very favorable. These were the highest technical type jobs, scientific jobs. Then the next thing that should jump out at you in this chart is that pretty much every other sector had some, aside from federal government and retail jobs, had some sort of growth. That was a change from the 2015 through 2018 period when our job growth was heavily concentrated. We really only had growth in 3 sectors prior to 2019. And so this distribution is actually quite favorable because it shows that the other industries had started to gain traction, whereas they hadn't quite gotten there earlier. Retail trade has been losing jobs for 2 consecutive years, and the pandemic is actually going to exacerbate this issue that's been restructuring. And so there's going to be a twofold effect for the pandemic on that sector. But if all things had held equal, 2019 would have put us on really good footing for job growth in 2020. And that's sort of good news, bad news, in that most of our industries were performing pretty well prior to this. And so what happens after the pandemic can hopefully trade on what the 2019 performance was and leverage that. Now, one of our continued problems in this area is our overdependence on the federal government. We were hurt by that in 2013, 2014, and since that period, federal activity has more or less been flat, which means that our current level of job growth is what we would expect without any sort of major changes in our economic composition. The goal, though, in the long term is to pivot away from the federal government by having bigger private sector clusters. We talked, I think, during the Amazon days, we were talking a lot more about economic clusters. We have economic clusters here already. The problem is that they're essentially 2 types of clusters, and I've labeled them as established and emerging. The established clusters have been here since the federal government has been here. So there's no reason, and they don't generally outperform the U.S. Performance, and there's no reason for them really to do so because they're mature. So these are stabilizers, but they're not high growth sources. The emerging clusters, which is where Amazon would fit, is exactly the type of cluster that we're trying to grow faster here. There's still about, I think, there are more than 700,000 jobs in this cluster, or these 3 sub-clusters. They've underperformed the national average for this period, though, on average. And the main goal of the Washington Region Economic Development sort of strategy is to try to grow this cluster faster because it creates a virtuous cycle, and so that it can start to function more like a private sector cluster would elsewhere. Now, there we go. Job growth on a monthly over the year basis. This is sort of switching gears to what we can talk about going forward. You can see pretty easily where the 2009-2010 recession was through that dip there. And you can barely see a minor dip around 2014 period. But if you just look at the jobs data, you wouldn't expect there to have been a recession in the 2013-2014 period, but not one in 2009. And so that's why I'm going to discourage everyone from exclusively looking at the top line jobs numbers. If you are looking for one data source, I would actually recommend this. The Fuller Institute runs a coincident index that has 4 composite components. Sorry. And you can actually see sequestration show up in this data series. And so it won't necessarily show the magnitude of the decline, but it will do a better job of showing when we start to have a decline. When there is a year-over-year decrease in this index, especially for multiple months, it almost always indicates a recession. And so this is really a better source for it. We have data through February, and it was still growing in February. I'm guessing that it will decrease in March, but the March data won't be out until the end of next month. The second piece of the Washington, so I guess the corresponding piece of the coincident index is this leading index. Just like the national leading index, we have a local one here. The trick with the national or with either of these leading indexes is that they forecast things based off of economic conditions. And what we're seeing right now is that economic conditions aren't what's driving this recession, it's health conditions. So leading indices in general will be less helpful in figuring out what's going on in the economy going forward, because it only shows you what we know based off of economic factors. Prior to the pandemic, the Washington area's leading index had been pulling down for about 1.5 years. There's some disruption here because of federal government shutdowns, which move activity around. And so you can see that at the end of 2018 and into 2019, there were bigger decreases, and that in the spring there was that bump up. And most of that is because of the shutdown. People were just changing when they were doing things. And the main reason that our leading index had been pulling down prior to the pandemic was because of our labor force. Our labor force had reached unsustainably tight levels. So eventually that starts to pull down job growth numbers because we weren't growing our people, we weren't growing housing, and we weren't growing our labor force like we should have, or we had been doing in the past, in order to keep going with the job growth numbers. Obviously, right now, labor force tightness is not the main concern, but again, at the end of this pandemic, these are the conditions that we will likely return to when we think about what the recovery looks like. We won't just bounce right back into these conditions, but the pre-pandemic conditions are going to be what we're looking at for what the recovery could go back to. So that is where all I have on the pre-pandemic components. So if you have questions about Amazon or anything prior to essentially March, if you have questions, let me know or let Jared know.
Yes, sorry, Jeanette. I just want to put the the phone number up so everyone can see it. To call in, it looks like some people are still having issues with the audio. So if people want to grab a quick pen and paper to write down the phone number, I'm going to give it in a couple of seconds. It is 415-655-0060. Again, that's 415-655-0060. The access code number is 302-950-893. Again, that's 302-950-893, and then hit pound. If you were unable to get that, just shoot us a message in the questions. We'll have somebody respond to you with the telephone number. And again, we apologize for any audio issues. We're doing our best with technology, and it's great when it works. But on days like today, we're experiencing a little issues, but we're going to try and work through it as best we can. So thank you for bearing with us. I did not see any questions come through. It looks like mostly people a little upset about the audio not working. So again, sorry about that. And back to you, Jeannette.
Great. So launching into what we know about the pandemic, the normal data sets here aren't really helpful because of the speed of the recession here. And I'm going to go ahead and say that it's a recession based off of what we know now. And to illustrate this, I'm going to show you a few data sets that have more frequent numbers. And the first being the number of TSA passengers that they check. This is daily, and it shows the comparison to the same day the prior year. The decrease here was very, very steep. In early March, we started off at about the same levels as we did in the prior year in 2019. By mid-March, they were more than halfway down, and since the end of March, essentially they've been down around 95%. So international travel started to go first, domestic travel started to go a little bit later, but by the end of March, long distance travel was down by about 95%. So that's a huge decrease. It's unprecedented, and it's actually larger, I think, than 9/11 based off of some of the data that I'm seeing. This decrease shows up in the hotel numbers, obviously. And as of the week ending April 18th, hotel occupancies were down about 65%. Hotel revenues are down more than that, because what hotels have done is lowered rates in order to get more local people, the people who may be sick of working from home or people who need to be a little bit closer to the hospital or whatever the case may be. So hotels revenues are probably, as of sort of the end of March, early April, they're probably down about 80%, maybe 85%. And they'll hold up a little bit better than those passenger numbers, the long distance, because of the local travel. The last piece I'm talking through, this is one major sector. It's the leisure and hospitality sector that includes accommodations, restaurants, and entertainment. Restaurants also had the same path of decline, and you can see here the DC numbers and the US numbers track pretty similarly. And this is really just to show that the Washington area right now isn't special, especially if you're looking at industry level information. The industry level pieces are all being affected the same, and the fact that we have revenue from the federal government
It looks like we lost Jeannette. I'm not sure if people can hear me or not, and I'm not sure if Jeannette, you can hear me. We're sorry about this. Jeannette, if you look under the audio tab on your screen, there should be a pin for you to enter to regain connection. Again, we're sorry, we're having some technical difficulties on our end. Let me see if I can get through. 1 second. Sorry again, everybody.
Sorry about that. Can everyone hear me?
Yes, we can hear you now.
Yes. Okay. I'm so sorry about that. I don't quite know what happened. Okay. So entertainment revenues have also dropped off, and I'm using the cinema box office numbers just to illustrate that. The timing was basically the same, and the magnitude was a little bit stronger because these obviously have closed. But again, they were falling in the weeks prior to the official closings as well. The next piece of the industries that have been affected it has been the retail industry, especially the non-grocer retail. Total retail sales are going to be down. The March onward data on this chart are a forecast. And one of the things that I want to show is that even though food store and non-store retailers, non-store being mostly online, are holding up better, they aren't, the sales bump there isn't enough to account for a sort of flattening out of retail sales overall. So it isn't that consumers are spending the same amount overall, they're still contracting with their retail spending. This chart is a little bit misleading because it does show year-over-year changes, and it looks like things bounce back really fast. However, the decrease in 2020 doesn't actually fully get made up until 2021. So the growth in 2022, the growth in 2021 is not large enough to account for the loss in 2020. So it's not what people were talking about. We talked about the W-shaped recovery. Early in this pandemic, we were talking about this V-shaped recovery. It won't be a V-shaped recovery. We could have only had a V-shaped recovery if it had lasted very, very, it had been a very short period of time. The longer it lasts, the harder it is to rebound because things are affected and the supply chains get more complicated. And there are a few other reasons why we can't just bounce right back. But for consumer spending, one of the main pieces going forward will be consumer confidence of how people are feeling. And depending on their attitudes about how the institutions have handled this pandemic and what they think about future pandemics, some may actually permanently change their spending habits. And it's hard to know exactly how that's going to play out and how comfortable people are going to be going back and spending at the same levels. Now, the other piece of the recession, at least locally, has been that we have sent everybody home to work from home. And I'm using this chart just to illustrate most of passenger miles or most vehicle miles are from commuters. And so our commuting basically is down 40-ish%. Like I said before, this decrease is pretty similar across the US, and the timing of the decrease was also fairly similar, especially if you're looking at things on a monthly basis. Everything looks very much the same. If you can drill into what's happening by day, you can start to see some minor differences, but really it comes out, especially if you're looking at things at a monthly basis. Now, when you send people to work from home, there are productivity losses that happen with that, and meetings don't happen as efficiently. People, your presenter doesn't know how to unmute herself, so you lose 10 minutes. and those add up. So there are productivity losses. Even if people can still do their jobs at home, we don't do them quite as well because that's not how we're set up to. And eventually what happens is that we postpone things that require face-to-face interactions, and we reach a point at which you can't postpone them anymore, and you start to have a doubling down of that productivity loss. One of the advantages that our metro area has that some other areas do not is our industry base is primarily, we're a knowledge economy. So we can actually send more workers home than many other metros can. And we don't have manufacturing, or we're much less reliant on manufacturing. The metros that were hit hardest and first relied on international manufacturing supply chains, and that is more or less in recession right now. We don't have that problem. We also aren't an energy producer, so we aren't being hit by the decrease in gas and oil prices like other metros are. So that is really, those two things are some of the main differences that we have. Neither of them have anything to do with the federal dollars, and it has more to do with the types of workers that we have here and the types of industries that we have here overall. As I said, the longer the pandemic lasts, the harder it is to have a really quick rebound. And a major component to this is that normal business activities aren't happening right now at the same rates that they used to. And in particular, business creation has dropped off by about 25% over 5 weeks, or in total for 5 weeks. We can't just double up on business creation for the next 5 weeks and have it be caught up completely, especially now that the financial markets and the capital markets are going to be much harder to access, especially for new businesses. Existing businesses, we're trying to stop some of the bleeding there, but for new businesses, these numbers are going to be down for quite some time, and it's going to be compounded by the fact that we have had decreases we've had an uptick in business destruction rates. So at the end of this pandemic, even if the health crisis was solved today, we would still have probably 2 months of losses because of the way that the business creation and destruction has played out. There won't be as many businesses for new or existing workers to go back into at the end, and it'll take longer for these new businesses to start back up again. What we've seen so far on the labor market side, I think most everyone's been paying attention to these jobless claims data. In the Washington area, or in the tri-state area more broadly, we've had about the same number of jobless claims as we did for 3/4 of a year during the recession. Now, our recession wasn't really the same as the rest of the US, so keep that in mind. But the contraction in the labor force has been unprecedented, and it's primarily because there's been a near shutdown in those industries that I talked about just above or before, the leisure and hospitality, non-grocery retail, and those are the two that have been affected most. And then there have been some auxiliary pieces to this. So the jobless claims numbers are a good way of monitoring how fast and how severe this is, but they don't tell us very much about how long or what the implications of this decrease are, because a lot of these jobless claims, unlike a normal recession, these aren't necessarily permanent. So if you lost your job in 2009 or here in 2013, you lost your job and that was the end of it. Here, even if you lose a job, it's unclear about even whether or not you can go back to work with that same employer after the pandemic has ended. And so the layoffs are not layoffs in the same way that they used to be, because there is still a likelihood that many of these workers will be able to go back to work. The question is when and how. the good news here is this chart is a week old, which doesn't include the data that came out yesterday. The good news is it looks like some of these jobless claims numbers are starting to taper off a bit. In a week or two, the gig economy workers will be able to file. There have been some technical difficulties in letting them file thus far, so they're not in these data right now. So when the numbers will probably start to rise a little bit, and that increase will be because we're letting new types of workers file for claims, not because there's been a shift in the trajectory. So this is sort of a light at the end of the tunnel that the first wave of firings is probably finished and that we can be okay in stabilizing for a little while. Now, I'm going to talk about jobs and then I'm going to do the forecast. And I think I'll just wait and do questions at the end of these two sections because we lost a little bit of time from my incompetence there. So job numbers in the nation are available on a monthly basis on a seasonally adjusted, so seasonally adjusted month-to-month basis. And in March, the U.S. lost 701,000 jobs, and that loss was obviously much faster than it was during the 2008-2009 recession, but it actually wasn't any steeper necessarily. It was just very sudden. Drilling into the industries of job losses, one of the things that may surprise people is that there were losses in most industries, leisure and hospitality being the hardest hit, but there were industries that at their face seem to be surprising. So education and health and professional business services in particular, those two are very important for our region. And you would think that education and health would be a little bit more insulated, as would professional business services. But when you actually drill into what these job losses were by sort of detailed subsector, it makes a lot more sense. So the largest decrease was obviously in restaurants, that's food services and drinking places, so it's restaurants and bars. The next largest absolute decrease was temporary help services, temp workers, and those are in professional and business services. So temps are categorized with the same white-collar jobs, and those always fall off during recessions because they're temporary. The third main sector, or the third largest decrease, was from ambulatory health services. These are walk-in doctor offices and physical therapists and dentists. And so that makes a little bit more sense when you see that decrease in health and education. The other educational piece is in the middle of this chart, and it's child daycare services. So these are they're framed as educational because they're kind of preschools, and there's a little bit of childcare and preschool are sort of one and the same. Depending on your philosophy, but they're grouped the same here. And then the rest of the decreases are probably more or less as expected. I will note that the construction decrease is most likely because of the decline in oil prices, because construction doesn't just include buildings. And so the construction decrease here isn't necessarily exclusively because of the pandemic. It's actually because of, well, it's tied to the pandemic, but it's more because of gas and oil. On a percentage basis, though, I will caution everyone from thinking that this is sort of, we're nowhere near what the magnitude of these decreases is going to be. The food and drinking places employment only decreased 3.4%. Revenues there are probably down somewhere between 15 and 20%, depending on how you slice things. So that mostly explains the difference in those upfront job claims and what you're seeing in the March data. The March numbers are all jobs data are as of the pay period of the 12th, so basically the middle of the month. And so what you're seeing in the March numbers is really just the very beginning of what we're going to see in these job numbers going forward. But the good news here is that the affected industries are matching with what the other data are showing, and frankly, what is intuitive. where the job losses in April and May will most likely just accelerate in these same categories with some slight differences, but most of the losses will just intensify in this grouping. Now, in the Washington area, so the Washington area doesn't really get monthly data because the seasonal adjustment is too noisy. And so it makes it very difficult to understand what's actually happening. So instead, I'm going to show the year-over-year changes. This is the US chart, and you can see that it was roughly down, the growth rate was roughly down by half. That is exactly what happened in the Washington region in March. We were down about 44% from what we had seen prior to the pandemic. And again, this matches the US pattern. Similarly, the other large metros had about the same level of decrease, as did other places in the US. And I'm just driving home the fact that when you are thinking about what's going on, the national number, you can almost use the national number and extrapolate based off of that, and then make some minor adjustments because we aren't affected by oil and we aren't affected by manufacturing. That's really going to be the main differences going forward. That's a slightly different mentality than we've had before, where you look at the national numbers and it rarely corresponded with what we were doing. By sub-state area, again, each of the sub-state areas is doing essentially the same thing. There are going to be some minor differences here or there with timing and industry level, but the magnitude of the decrease has really been the same overall. We don't have quite as many sectors. We don't get the same level of detail as the nation. But again, like the nation, leisure and hospitality was the hardest hit, followed by education and health. That subsector there is mostly just education, and it's probably just childcare as of right now. But we'll probably have a same decrease from ambulatory services later on. Everything else has held up a lot better. Professional and business services did take a hit from the administrative and help. That temp worker component is going to start to fall off. So those numbers will start to decrease. But right now, our high wage jobs, we're still more or less holding on. Going forward, I've talked a lot about the types of jobs that have already been affected. One of the things to keep in mind, like the 2008-2009 recession, the leisure and hospitality, retail, and then these personal services jobs that have been hit, laundry, maintenance, things like that, they tend to have lower wages, and they tend to be part-time, or they have a higher share of part-time work. And overall, their output is much lower in terms of overall economic value than just that sheer number of jobs. So even though they account for roughly 20% of the jobs, they account for much less of our economic value, which means that as they get cut, the top line number when you're just looking at the jobless claims is actually going to be significantly larger than the economic component here. Not to undercount this, the problem with the industry cuts that are so concentrated, though, is that these workers tend to live in low-wage households. So they are the least able to adapt to this change, and they can actually least afford to stay home, which helps reinforce some of the policy pieces that we're doing on the federal and local level to try to stabilize household incomes so that these households can weather this pandemic. They are going to be the first into this recession. They will also be the last out, probably, especially if some of these businesses don't survive. So if restaurants close, just sort of broad-based closures, it takes time to start restaurants back up. So they won't be able to just instantaneously get back to work. This forecast was as of March 30th. And so for the Washington region, I think we're probably on that green trajectory right now as opposed to the red trajectory, where we will see a decrease in our economic activity of about 1.6%, I think 1.4%, before it bounces back up 2% in 2020. This is probably a little bit optimistic. I think, again, it depends. This forecast assumed that we would be able to start opening back up in late May, early June, and that so by the mid-June, we were pretty much doing things more or less as normal. It looks like that's not going to be the case right now. We can probably, the best case scenario is that we can start to try to open back up, but only open maybe halfway or a third of the way. I'm not really sure where this falls on no one really has started to open back up yet in the US, and so we'll have to be watching what they do very closely to see how that works. That is where I am right now. The problem, again, with this pandemic overall is that there is much more uncertainty baked into economic numbers that are tied to health factors, that the health crisis will determine how our economy moves going forward. And again, this is absent of any policy intervention because people will change their behavior until it feels safe to go back to normal. Not everyone, but enough households will change their behavior that it has a bigger impact on the economy than just the policy piece. The next piece that if what we're doing right now, these stay-at-homes don't seem to be making any difference. It looks like they are, but if for whatever reason we need to start doing a sort of phase 3 for shutdowns or whatever, the economic losses will bleed into other sectors. Businesses can only survive on so much uncertainty, and if you can't make plans for 6 months from now, what your business planning is, what your capital investment is, and you hit pause across the board, eventually you start to reach that point where you don't have plans for your current period, and that means that you have real revenue losses, real economic losses, and you need to start adapting to that. So you start cutting workers, you start cutting salaries. So there is going to be, in the not too distant future, a trickle through to other sectors. As a result of that ripple effect, the income losses on the household side will be much larger. Right now, the income losses have been isolated to those major sectors that I talked about earlier that tend to be lower wage to begin with. And however, people are interpreting their loss in stocks and equity. Generally, because stocks and equity are more volatile, and you know this, it depends on where you are in your life spectrum, but most people, if you're still in a working age, prime working age, you just aren't looking at your portfolio, or maybe you're calling your advisor to try to figure out what to do next, but you're not yet changing your spending patterns because of that. Now, unlike the housing bubble, where people invested in their housing as a huge portion of their stable net wealth, when that crashed, people changed their spending behavior because they felt and they were less wealthy. Stocks tend to react a little bit differently, but going forward, that could change. That would get coupled with a change in consumer sentiment where people just start to feel uneasy about the state of life as we know it or don't know it. And so they change their spending behaviors more permanently. And then the last piece of this is that as the shutdowns continue, the economic bottlenecks that we have get more complicated and more broad-based. So if you can think about the supply chain problems that we had early with international manufacturing, that's just one piece. But when there are bottlenecks that go through because of the lack of face-to-face interaction for the knowledge workers, that starts to get more complex and it starts to become more additive going forward. So the main next round of potentially affected sectors will be the sectors here: financial, professional, construction, transportation, and warehousing. And the likelihood of this is, or the likely scenario here is that these sectors will be affected almost, it will snowball. So it won't seem like there's a clean pivot point necessarily, but it will bleed through really quickly to different sectors, and it might be a little bit unpredictable about when. I think we may be reaching the point in the next week or two of the bleeding through to other sectors. There's not really enough data to know for sure because we don't collect daily or weekly data, especially by sector like this. And so we just have to wait and see on that front. And as I mentioned, consumer confidence is going to be one of the key things to look for on the recovery side, on how people are feeling, even if there aren't significant income loss overall, or if there isn't significant income loss. If people are concerned that our institutions haven't performed well, or that they need to change their risk preferences going forward, they will change their spending patterns, which means that we won't actually get back to a pre-pandemic level. We will have a restructuring overall. And that's all I have. I know I went through some of that pretty quickly. So if there are questions, Jared, feel free to let me know.
Yeah, sorry, Jeannette. It looks like most people were cut out when we lost audio, but I have a couple of questions for you.
Sure.
So it looks like some of the data that you're showing is pretty bad, and it's got pretty bad pretty quick. We're already pretty much where we were on a couple of fronts where we were in the great financial crisis. So at what point do we stop calling this recession and it becomes a depression?
The definitional difference with recession and depression is usually one of length and magnitude. Unlike other nations, we don't just use a 2-quarter decrease as a recession definition. We actually have a little bit more of a subjective piece to this with income loss, but it's safe to say we're in a recession. Depressions usually have to have longer and more sustained losses than that. So essentially, we would need this pandemic probably to last for upwards of a half a year or 3/4 of a year before it really hits depression. And on a technical side, people are using depression right now to illustrate the magnitude of the decline, which is not, it is a way, but one of the main differences here, it's not my preferred way, obviously.
Right.
One of the main differences is that depressions usually require something more systemic that needs a different trigger to recover from. And so you can think of most people think of what got us out of the Great Depression was a war, and that's to some degree true. And this pandemic isn't necessarily going to have the same effect, although it will feel very bad for a while.
Right. One of the other questions I have is that, we've seen the federal government be able to issue debt to deal with some of the losses that we're taking on here. I imagine that state and local governments are going to be hit pretty hard by losses in revenue. Like, people aren't going out and buying as much as they were, so a lot of sales tax and stuff like that is going to go away. How are state and local governments going to deal with losses in revenue?
This is why we have reserves. This is why we have emergency funds and reserves. We will probably run through a lot of those, if not most of them, and then we will all need to think differently about, we're all going to have to pay it back going forward. And there's not a prettier answer than that. And how we get there will be different depending on the state and the locality. But in general, I think residents and local businesses will need to find a way, or will end up being taxed to get that revenue back. Just sort of the normal order of operations.
Mm-hmm. Yeah. And then you had a couple of slides showing kind of about the harder hit impact for lower earners. And I think it was, becoming more and more clear there was a growing divide between the haves and the have-nots before this, and it seems like this event is going to make it a little worse. What impact will all of this have on the wealth inequality effects?
It highlights it. It has been a growing issue for a while. Really, it's been triggered by the hollowing out of the middle wage jobs, and that has been going back easily 10 or 20 years. And so we've been left with a really bifurcated economic structure, and household structures actually exacerbate that. So when you look at the spreads, they get wider when you look at households compared to wages. And so I think this is going to change how we think about what social safety nets are. We've been talking a lot about what the role of business is. So are businesses obligated to pay the living wage, or does that fall under a social safety net, and what the tipping points are? And I think those conversations will speed up a lot. And so in the short term effect will be nothing. In the short term, we're all just going to be trying to weather this. And actually, we may pause on implementing some policies. I think Virginia, I don't know if they've officially said that they're not going to do the minimum wage increases, or if that's just something where we are on that. But there are going to be some short-term pauses. But then going forward, we're going to have a bigger consensus about what the role of business is, what the role of government is, and how we solve how we treat the households that are most vulnerable, and what kind of intervention strategies we have there.
Yeah. So Lisa talks about having read maybe this recovery will be a W-shaped recovery, and there's been a lot of letters thrown out about what it will look like as far as recovery. Does the economy being on strong footing before the coronavirus have an impact at all on what the recovery is going to look like, or can we basically throw what was happening and going on a couple months ago out the window at this point?
I think I would be cautiously optimistic that the economies that were doing well before would be able to recover faster. And again, this is based off of there will be differences based off of kind of industry composition. In our area, the only real benefit to having the federal government right now will be on the recovery side. So as I said, it won't help us on the recession or the magnitude of the recession, but the federal government will pick back up much faster than even other private sector businesses, because it has a mandate to do so. So I think that will help move us forward faster. But like I said, it's really only 30% of our economy that is tied to the federal government, and so it won't lift us up immediately.
Great. Lisa, I don't know if you're still muted, but it seemed like you had a couple questions. If you want to jump in now.
Yeah, thank you, Jared. And Jeannette, again, thank you for being here with us, and thanks for bearing with some of the technical issues. I'm curious what you imagine could be those systemic risks out there that would take us from a recession to a depression. And then I have another question after that.
Sure. The systemic risks that I would see would be, so firstly, the health crisis, if it doesn't have a resolution. That's unlikely, but if it doesn't have a resolution, or if we think we have a resolution but we have the wrong resolution, and so we get hit again, that would cause a depression. If the financial markets collapse, that would, like last time, that would cause a recession, or it would cause probably more of a depression than just a recession, because it would affect our recovery. And I think I think those are the two big ones. Similarly, if the global economic crisis if we get another round of that, I think globally it looks like there's been a little bit of stabilization, that things are getting a little bit better. But if that turns out to not be the case, then that would help. That would spur a more depression-like scenario. But the length of time here is also really key. So all of this would need to last for more than 6 months in order for it to really hit that depression mark.
Got it. So thank you. The other question I have is, when we finally get to the point of thinking about stimulus versus stabilization, which I think is most of what the policies so far have been, is just stabilization. What would you imagine in this region would be most helpful from a stimulus standpoint to spur a recovery?
The stabilizing here is going to be the key. And if, again, when the health crisis is over, if we have retained our main economic mechanisms for production, so if our businesses survive, then we will recover faster. That's the key. The potential piece for a more true stimulus would be to get business creation rates back up so that you can sort of double up on those, so that we can make up for the loss of business creation during this period. But that will probably happen more naturally as long as the financial markets are still functioning. And again, that's sort of a question that could come to the forefront sooner rather than later. But the main reason that people aren't so focused, at least on the economic side, on a stimulus is because, unlike other recessions, we don't need to stimulate the economy to make it work. We need to make sure that it is just preserved for when our labor force can go back to work and when consumers can start spending again. Things will pick back up.
I think that's a great way to think about it. And do you feel like, without being political, do you feel like the Washington region has taken a more conservative approach, or around the health issues, and proactive approach?
Locally, I think we've done fairly well. We in general were in the first waves of information and policy changes. The caveat being that, so Virginia, the Commonwealth, is significantly larger, and so the policies there are harder to implement than they are in, say, the district or even in Maryland, because Southwest Virginia didn't have any cases at all for a month after the first cases in Northern Virginia or in the sort of the Tidewater region. And so to implement policy changes for the entire Commonwealth when everywhere wasn't being affected was, whether or not it was political, I will punt on, because I'm not a politician per se. I don't read into those lines, but on an economic side, it still made sense to wait a little while, which is maybe why Virginia lagged there.
Well, Jeannette, thank you.
Oh, there we go.
I don't know that there's any other questions. I don't see any other questions. But again, we're really appreciative that you've joined us today. I think it's very timely information, obviously subject to evolve and change. And obviously, we're going to have a recording of this. We'll be sharing that with everyone shortly. But thanks again, and hope that you stay safe and stay healthy.
Yes, same to you. Thank you for having me, and I apologize for the loss of sound there.
Wasn't you.
All right. Thanks, guys. I think we'll end it here, and we look forward to getting this uploaded, and thanks for watching.